Wednesday, February 2nd, 2022, Maneco 64, home of alternative economics and contrarian views. So the national debt is hit 30 trillion, while an uber globalist journalist has lost faith in the Federal Reserve. Is that important? I think so. And is it a surprise that the U.S. national debt is hit 30 trillion? Of course not. It's just a significant number. And I know, of course, there's all the unfunded liabilities, right? I think you've got Social Security at 21.7 trillion. You've got Medicare at 33.7. So, and you've got the unfunded liabilities at 164 trillion. So we're talking hundreds of trillion. So 30 trillion is actually not huge, but it is the national debt. And I haven't even covered, of course, the missing trillions that Dr. Mark Skidmore and Catherine Austin Fitts have dug up. Of course, that's all hidden now because President Trump signed FASB or FASB 56 rules, which basically makes the whole accounting of the United States Treasury or government very opaque. They can hide everything. And they can even hide things for major corporations under national security, of course. But there's a lot of other things that are important today, I think, that we need to touch upon very briefly. But my focus, of course, will be the national debt and the fact that a globalist is losing faith in the Federal Reserve's ability to keep prices from rising or to keep the faith and confidence really in the currency, with the dollar. The dollar is, of course, the financing instrument for the globalists. Yes, it is a multinational, international group, but they use the dollar, they use the American public to finance their operations in order to actually, what they've been trying to do is bring down the United States. They don't like nation states. So that's quite significant. And you might say, wow, that's the currency of the United States. Well, I would say it's more of an instrument of the globalists. So who is this globalist that's losing faith in the Federal Reserve? I've spoken about him many times. He writes, not surprisingly, for the Financial Times, which I would say is the biggest proponent of globalization and is the biggest mouthpiece for the globalists, for central banks. And the journalist is called Martin Wolf, and I've touched upon him before. And I've touched upon an editorial that was written in the FT about gold back in April 2004. And at the time, gold was struggling to get up above $400, which was a really important historical level at the time. It was a level that gold had tried to get back above in the 90s and failed. And here we were in 2004 testing that level. And this is what the FT wrote. And there's no name of anyone who wrote this. I wouldn't be surprised if it was Martin Wolf. But anyway, it said going gold. And many of you have seen this before, of course. And it says the pointlessness of holding bullion continues to sink in. So yeah, the price was at $400 exactly. And I'm not going to go through the whole thing, but I'm just going to go through a paragraph here that's very relevant to what Martin Wolf just said yesterday. And we're going to go quickly through his article from yesterday, his kind of opinion piece. But back in 2004, so here it is, this editorial said, the one advantage of gold as a reserve asset is that unlike assets based on fiat money, governments cannot make it worthless by inflating it away. But in an era of low inflation, and given that independent inflation targeting central banks are the norm across the industrialized world, that risk has very sharply diminished. So it's gone 180, as you can see, because what's Martin Wolf saying now? Well, the Fed is too late to remove the punch bowl. Policy is still aggressively loose, even though the recovery and surge in inflation have long been clear. Well, I could have told you that years ago, Mr. Wolf. They've been inflating, like you mentioned, or the FT mentioned here, that central banks, independent central banks, wouldn't be inflating, right? They've been doing it since 2008, since the great financial crisis. And that inflation has been hidden, partly because people don't understand what inflation really is. That is the creation of currency and credit out of thin air. It's not really based on real savings and sound money. And they've been able to get away with it until the last year or two because they fudged the consumer price indices data. And the Cantillon effect, and I'm not going to go through the Cantillon effect. You can Google it and have a look at what it is. The Cantillon effect made it so that the initial inflation from 08-09 QE and QE 1, 2, and 3, and the zero and negative rates, the Cantillon effect made it so that all the inflation flowed into financial assets. But now it's flowing into the real world, and that's what we've got. So it's not only the inflation they created after the collapse of March 2020, but it's all the other inflation that is in the system ever since they raised the Fed's balance sheet from just under $1 trillion and now to almost $9 trillion. The interesting thing about this editorial here, you see this picture of a punch bowl. It's a green punch, but I'm not sure if it was on purpose. They've put some silver coins, 1 ounce silver eagles in there. I thought that was quite interesting. Is that a sign? I don't think so, but I thought that was quite a good picture. And just to let you know, there you go, Martin Wolf. He's a frequent, how can I say, participant at the World Economic Forum in Davos. It says here, he has been a forum fellow at the annual meeting of the World Economic Forum in Davos since 1999. So there you go. He is an uber globalist, and he writes for an uber globalist publication. So there you go. I'm not going to go through what he talks about because what he's giving us here is the consequence of the inflation. He's talking about food prices, how consumption's increasing, prices are rising, but no mention of all the inflation like the M2, the QE, the zero rates, because he sat in that mindset that looks at the consequence of inflation, and that's why he's missed out. He's been wrong. But it looks like he's woken up. He's jumped ship. He realizes that the Federal Reserve is screwed up. Not only the Federal Reserve, but all the other major central banks, I would say, ECB, Bank of England. And this is what he says here towards the end. I'll go through it for you. And I'm going to put a link to this in the description under archive.ph. So that you can click on it and read it, because there's a paywall for the FT, but I'm going to make it so you can read it, the whole thing. It says, in this context, the Fed board's December forecasts are bewildering. The median, and I think that's significant because these kinds of people and publications always try to give the Fed the benefit of the doubt, but the fact that they're using the word bewildering is significant, in my opinion. The median view is that core consumer price inflation will fall to 2.7% this year and 2.3% in 2023 as the unemployment rate stabilizes at 3.5%. Core inflation as well doesn't add food and energy, so what good is that, right? Meanwhile, the forecast is for the Fed funds rate to be between 0.6 and 0.9% this year and 1.4% and 1.9% in 2023. If we leave out the three highest and lowest forecasts. These forecasts are, we must note, below the Fed's own estimates of the neutral rate of interest, which is 2.5%. Moreover, the assumed real interest rates are also negative. Perhaps board members believe that aggressive asset sales will deliver the need tightening via higher longer-term rates or long-term rates. Alternatively, they have to believe that the economy and inflation will stabilize smoothly, even though monetary policy stays expansionary throughout. And he says this would be immaculate stabilization. It's like immaculate conception. So basically he's saying it's rubbish. Really? It is conceivable that the policy settings chosen during the worst of the COVID crisis still make sense today. It is conceivable, too, that the forecast tightening will deliver robust growth and smooth disinflation. While disinflation is when you still have inflation, but at a lower rate. Both are less unlikely than that the moon is made of green cheese, but likely not so much. So there you go. That's what he thinks about Federal Reserve policy. Just wanted to show you a few comments from the comment section of Martin Wolf's editorial piece about the Fed. We've got here WKL2. He said, or she said, "This is a bit strong, if not disingenuous, from a senior commentator who has been crying deflation for 2 decades. Just a quick Google search finds," and he quotes Martin Wolf, "A lot of people told me that there would be hyperinflation, and I consistently argued year after year that there was no chance of that. And I was right. I would say the same again. In the medium run, in the next 2 to 3 years, the danger is that we will go into deflation." Martin Wolf, 2nd of May 2020, Buenos Aires Times. Change of mind then? I think he has. And I replied, at least he is admitting he was wrong. The reason he was wrong is that he looks at inflation as price rises, or CPI, instead of the growth of currency and credit that has been abnormally high since 2008. And just because the central bankers were able to get away with price rises, now the inflation is flowing into consumer goods, services, and tangibles. Look up the Cantillon effect. So I replied to that, of course. There's another one here. Regular visitor says, "Has the FT been strongly advocating tighter monetary policy over the last 12 months? Question mark. I certainly remember the editorial panel, of which Mr. Wolf is presumably a leading member, opposing the Bank of England rate increase in December. If he has been shouting off the roof tops, I guess, about the dangers of persistent inflation, I missed it. It could be me. I don't think he missed it. He's just, Wolf has done 180. The other thing I wanted to talk about is Russia. They announced yesterday, the Russian news agency TASS, that Russia is going to ban the exports of ammonium nitrate from today till the beginning of April for 2 months, February and March. Ammonium nitrate, what is ammonium nitrate and why is that important? Well, it's widely used in fertilizers and explosives. So very important for the agricultural, for this food supply. Again, and why does it matter that Russia does that? Well, Russian Federation is the top country by ammonium nitrate production in the world. As of 2019, their production accounted for 61.64% of the world's ammonium nitrate production. So President Putin firing back at the West and the US and the UK for their threats of sanctions, right? Threats of pulling them out of the SWIFT system. And the other thing I would say, yes, the United States hit 30 trillion in debt. Debt to GDP is 128%. And I think this is another reason they don't really like the Russians, because their national debt to GDP right now is 17, yes, 17, not 70, 17.73%. And even their external debt to GDP is only 37.5%. So Russia has everything. They have all the natural resources, they have very little debt, and they're accumulating a lot of gold. Well, I guess if you're following this channel for the last few years and you've done some of the things that I do that you thought were a good idea, you've become a little bit like Russia, like a sovereign, independent country, little debt and a lot of precious metals. And I think that's going to be a good way to survive. And I think that's why the West is so hostile right now towards Russia. So now let's look at where the markets are this morning. It's 10 to 9 a.m. London time. We've got spot gold trading just around 1800. We're at 17.99, down about $2. Range has been 1802.50 and 17.94. Silver is up about 10 cents, 22.72. Range has been 76 to 59. Pretty tight range, narrow range at the moment. The Dow future is down 57. The NASDAQ is up over 1%. I saw Alphabet, which is the parent company of Google and YouTube. They announced good earnings. They also announced a stock split. Basically, that means that their stock price is going to be $150 instead of around $3,000. It was a 20-to-1 split. Does that make the stock more valuable? No, it just changes the number of shares that they have. But psychologically, it's easier to buy a stock that is $150 than one that's $3,000. So I think that's put a little bit of a rocket up Alphabet, aside from their results. So yeah, the NASDAQ futures are up 172 points. S&P futures up about 19 points, or 0.5%. The FTSE is up 42 points, or 0.5% at 75.66. To the currencies, we're continuing to see the dollar drift lower versus the major currencies like the euro and sterling, and even the yen. Right now, sterling is up 0.1%, 135.37. The euro is up slightly at 112.82. Dollar is down about 0.2% versus the yen at 114.53. And the dollar is unchanged versus the Chinese yuan at 636.47. Aussie dollar is unchanged, 71.23. The dollar is up slightly versus the Canadian dollar, 126.96. And the Kiwi dollar is down 1/8% at 66.30. To the commodities, WTI crude is unchanged, 87.50. High-grade copper up 0.5% at 4.45. U.S. natural gas up 3% at 4.86. And if you look here, the major agricultural commodities have made a recent high, and that's not surprising with the news from Russia about the ammonium nitrate embargo, if you want to call it. It is an embargo for 2 months. That's going to hurt, going to make fertilizer prices higher. It's going to affect the planting of agricultural commodities. That's going to affect the yield, and it's going to impact prices of food. It's going to affect the food supply chain. I don't think it's good news. So to finish off, let's quickly look at the 10-year yield, where we are this morning in terms of rates. So the 10-year yield is down 2 basis points at 1.78%. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.